Hey guys, welcome back to Finance for Firefighters. Today's topic is going to be income tax brackets. So we all pay taxes in several different forms, but I felt like it was important to cover some basic stuff on income tax brackets. So a term you've heard before, but I'll just kind of discuss it with you, is adjusted gross income. This is basically the gross amount of money that you're paid. Taxable income would be the adjusted gross income minus your deductions. And then net income would be all of your deductions take out, and net is basically your take-home pay. So federal income taxes and, in our example today, state income taxes for California are paid in a layered system, basically. So from a certain amount of money to another certain amount of money, and we'll get into the specifics here, but from 0 to roughly 11,000 for single is paid at a 10% rate. So all the money you make between 0 to 11,000 is paid at a 10% income tax rate. 10% of that is paid for that. You scale up to the next one, and so on and so forth. So you don't pay a certain percentage like, hey, I pay a 30% income tax. You're not paying that whole thing on what you're making. You're basically, it steps up, and sort of like if you think of layers in a cake. The first layer, you're paying the smallest amount. The next layer, in that piece of it, you're paying slightly more, slightly more, and so on and so forth. So the more that you make, that top end of your income, the last $30,000 or $40,000 worth of your income, is actually paid the highest percent taxes on that. So those are all called marginal rates. Each one of those is a different margin that you're taxed at. And then the effective tax rate is basically the average of all of that. So knowing these differences and having some strategies for you will make a huge difference in what you're doing for how much you're withholding, or even if you decide to go exempt, or if you're working a bunch of overtime shifts, things like that, you may want to strategize a little bit depending on your specific circumstance for different write-offs and stuff that you have. But if you change a few things, you're able to reduce some of your income taxes, or at least have some of them come back to you earlier instead of getting a large refund at the end of the year. All right, so nobody wants to pay taxes. I don't like paying taxes. You don't like paying taxes, but it is what it is on that. There are some things that we can do to reduce our taxable income. Okay, so things that you're probably familiar with on there is the government gives you the deductions, like we talked about, standardized versus itemized, but you also have pension contributions. I think right now CalPERS pension contributions minimum that they have for the employee is 12%. For my specific local, we pay 15% currently. The advantage of paying that is it actually lowers down your taxable income. So from if you're talking about, like, depending on if you're involved with the union on any of those negotiations or things like that, the pension contributions are actually a decent thing that are better to say, hey, if we had to give something up to pay into, because the amount of money that you're paying into that, you're actually not taxed on it. So if you're paying $15,000 a year into that, and you get a net or a gross income of $100,000, that lowers you down to the 85% or $85,000 rate, which is going to take you down in tax brackets. Okay, so pension contributions are lower your taxable income. Your 457 contributions lower your taxable income also. Currently, I believe it's $23,500 is the amount you can do per year into your 457. Your union dues are lower your taxable income also. And then if you have any kind of HSA or health savings account, VEBA is something that we currently have. We also have something called MERP, which is a medical expense reimbursement plan. That's basically like a firefighter's only trust that you pay into and build up time in that, and then you're able to use that for medical expenses in retirement. I'm going to do several different episodes on MERP. It's a fantastic program. A lot of locals are joining that, and it's getting a lot of traction. But that's another one that lowers your taxable income. So on the medical end, another one that lowers your taxable income is flex spending accounts. So these are typically like once a year. You have to do it before the year opened up, I believe, during open enrollment, like that September timeframe is. If I wanted to participate in that, for example, this year by September, I'd have to say, hey, I want to pay into flex spending, and I want to get up to, I believe it's $5,000 for a family or $2,500 for single. I could say I'd like to have however much amount of money it is, either the $2,500 or up to the $5,000, if I have a lot of big expenses coming up during that year. So let's take an example for me. If I did it for $5,000 for this next year coming up for 2026, I could say I've got kids with braces. Maybe I've got some sort of surgery set up. I'm going to be doing some other kind of any kind of medical related stuff that I want to do and use that money for. I can use that flexible spending. So the advantage of that is I can put that aside. They're going to basically take that $5,000, divide it by my 26 pay periods, and they're going to take that amount of money out per check for it. But as of January 1st of 2026, I could spend all $5,000 on that stuff, even if I haven't brought all the money out of the checks, right? It's still going to do it for the rest of the year, but I have access to that money right away at the beginning of that year, beginning of that calendar year. The other advantage is obviously it lowers my taxable income by $5,000, which is good because now I'm in a lower bracket and I'm paying for things I would normally be paying for anyway, but I'm doing it with tax-free money. The disadvantage is if you don't use that money, it's gone. You don't use it, you lose it. So I wouldn't want to overshoot it and say, hey, I've got maybe kids' braces, it's $2,500, and I'm not sure what the other part is, but I wouldn't necessarily want to max it out if I wasn't going to be spending all that money on the flex spending part of it. So real estate investment is another great way of lowering your taxable income. There's more details on this. I'm probably going to cover some episodes and maybe even refer you to some other YouTube folks that are like really dialed in with this stuff. But if you have real estate professional status or you're buying investment properties and things like that, there's certain qualifications that you need for it, but you can actually use those real estate investments, especially if they're short term, to be able to write off the depreciation of some of those kinds of things. If your wife does not work and just takes care of the kids, which means she works really, really hard, like mine does, if she does that, she would qualify for real estate professional status if we had an investment property and we're planning on renting that out. So by that being her full-time job, she could use that and we could write off the depreciation of that property to actually offset some of my W-2 income. Right? All of the money I bring in through the fire department is all completely easy to see and identify by the federal government. So using some of the stuff through investments on real estate and depreciation of it, we can offset the income I bring on that because it's showing like a loss on paper from some of those kinds of things, right? That's the downside about having a W-2 job is a lot of those things there's not really a ton of things other than the stuff I've mentioned that we can use to offset our income versus if you had your own personal business and you had vehicles and business expenses and all those other kinds of things. We don't have a ton of those things set up when you make a W-2 income. All right, let's talk about capital gains through investments. You can reduce the amount of money you pay on the capital gains through investments if you hold the investments for longer than 1 year. If you hold them for less than a year, you're doing more of like the day trader thing in the eyes of the government. They're showing that as just normal income. But if you have it longer than a year, it's actually taxed, and you sell it after that year, it's taxed at a much lower rate. So if you are going to be doing in the investment stuff, I definitely recommend, I'm much more of a buy and hold type of a person. If you have the accounts through your normal investment, like a brokerage account, I'd wait at least a year to sell that stuff. Because if you're doing less than that and you're trying to flip stuff, it showed as normal earned income. So holding everything longer than a year is another way of reducing some of the taxes that you're being paid, at least on capital gains. Typical stuff we can write off too is, depending on what you're involved with, any kind of charitable donations you can write off for your taxes too, which lowers your, at least if you itemize, it'll help with some of the offsetting of the costs. So for us, we typically donate clothes and things like kids' toys and stuff like that. So it doesn't end up being that much. It's usually a Goodwill thing where they give you the tag. We're usually $500 to $1,000 a year is pretty standard for us. If we donated a vehicle or a significant amount of money to any other kind of 501c3, a church, anything like that, you can use that to offset some of your income also through charitable donations. All right, so if you're a homeowner, some other stuff you can write off is interest on your mortgage, and then any kind of taxes through local, state, property taxes and things like that. You can use that to offset some of your income. So another piece, just diving in to talk about something that applies more to people that are closer to retirement. When you're running different numbers, we have a company that kind of breaks everything down and goes through exactly what you're looking at for estimations on how much you're going to be in through your PERS and 457 or any other kinds of contribution investments and stuff that you have. But some stuff to consider for you if you are looking at retirement or at least getting closer to it. The numbers that you're looking at are actually going to be based on something slightly different than what I am currently working at, right? And what you were used to doing when you're working. So when you retire, you have no more pension contributions, which is pretty significant. So 12% for the majority of people, for me, 15% contributions. You don't have to be paying into your 457 anymore. You can't be not paying into that anymore. You're also not going to be paying into FICA, which is 7.65%. So, and then if you're paying into an HSA or VEBA or MERP or anything else like that, all of those expenses are basically gone. So you don't have those deductions on it. So even if you're getting less from your pension check, your deductions are less. You may actually be taking home more. The other thing, obviously, that you are aware of is your commuting costs if you live further away. Incidental costs that you have while you're at work, food money or kitty or whatever else you're doing through eating and stuff like that at the station. But a lot of those expenses are going to be significantly reduced when you do retire. So when you're running your numbers, make sure that you add all that stuff in to make sure that you're actually seeing what your net take home is going to be. So for retiring folks also, other things to consider, and you hear a lot of this kind of stuff around the coffee table, but moving out of state tends to be a thing that a lot of us do. And that's really because California is one of the highest income tax states, right? So if you work here and you plan on retiring somebody else, hopefully you enjoy where you are and you're not trying to change where you're moving to. But the states that don't have, virtually every other state has lower income taxes than we do. But if you move out of state to a no income tax state, for example, you would be saving quite a bit off the top there. I think California's top income tax rate is like 13%. So if you went to a state with no income tax, you'd have 13% right out of the top, just by leaving the state and having residency somewhere else. All right, I'm gonna read a couple notes here because this is important. States with no income tax: Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Wyoming, Washington, right? So these tend to be a lot of places that people like to go. They have great reasons to go there, but having no income tax is a pretty good reason to move to some of those places. States with a flat income tax would be Arizona at 2.5%, Colorado 4.4%, Georgia 5.39%, Idaho 5.3%, Illinois 4.95%, Indiana 3.05%, Kentucky 4%, Michigan 4.25%, North Carolina 4.5%, Pennsylvania 3.07%, and Utah 4.55%. So a lot of different places outside of California that are a lot cheaper to live in when you do retire. Like I said before, this is a great state. There's a lot of great things about the state. The taxes are not so great about this state. So if you were going to be moving to a different state, soak up that state and appreciate it for what it is. Don't try to turn it into this state, right? So some other stuff to consider in retirement for being able to basically live within your means. PERS typically does at least a 2% COLA per year, but as inflation happens, it makes everything that much more tight, right? So before you retire, some great recommendations would be paying off as much debt as you can. If you can have no mortgage, if you have no vehicle loans, no other personal loans, all the other debt is washed away and clear, you won't need as much to live on because you won't have those bills, right? So if you look at your actual, how much do I need to make in retirement? If you don't have a $4,000 mortgage or a $3,000 mortgage, you don't have that bill, you're not going to have to pay that, right? So it's not just I need $3,000 or $4,000 for the mortgage. If you have to think of it from the taxable spot. So if I need $3,000 for the mortgage, I needed to take money from my 457, for example, to pay that, I would actually have to take out closer to like $4,500 every month just to pay $3,000 bill, right? So if you remove the bill before you retire, now it's not as much of a hit on you to be able to pay for those expenses. Every amount of money that you pull out from your 457 is actual taxable at that time when you do that. So it's not just $3,000 you need to pull out. It's that plus the income tax you're going to be paying on top of it to pull out to pay whatever that bill is. So if you get rid of that bill, now you don't have to worry about pulling out as much, and that money that you have in that 457 can last significantly longer. If you have less money in that and most of it's relying on pension, it's even a bigger reason to stand for it because you're pretty much on a fixed cost minus a small COLA that happens every year. But from that, if you can reduce all those costs and you don't have those, then you can really outlast your money in retirement. Okay, one last thing to discuss on this is a lot of folks do this where they work a bunch of overtime, or they go out of county and they're gone for 2, 3, 4 weeks, whatever, things like that. And they say, hey, I want to go exempt on this next check so I can get all of that money, right now instead of waiting until the end of the year to do that. Make sure when you're doing this that you're strategic about it. So depending on your tax bracket and how much you're typically going to be paying at the end of the year, you can do some of these calculators like I've shown you to have like an estimate of, okay, what's my normal gross income, about how much overtime have I worked, to be able to sort of extrapolate out how much you need to pay in the end of the year. If you're going to be going exempt, usually that's fine to do depending on your situation. I want to give a blanket statement, but usually that's fine to do maybe once. But if you do it much past that, and let's say you're like, oh, I have access to all this money right now, and you're not paying taxes on it, or you're paying significantly reduced taxes on it, you're going to have to pay eventually at the end of the year. So if you do that, make sure that you either adjust your withholdings to take more out, after you've done that, or make sure that you at least have cash on hand to be able to pay that tax bill when it's due, so that you don't just put yourself in a bad spot after that. Another couple ways that are good of reducing some of your taxable income if you are working a lot of overtime, depending on your department, is for us, we're able to do comp time, right? So if I was going to work an entire shift for a 24-hour shift in overtime, I'd make 36 hours of straight pay equivalent, right? Or time and a half of that 24 hours. And I'm taxed on that overtime as if I made that snapshot amount of money, that time and a half, all the time, right? So that's why a lot of folks go exempt, is because the government's taking a big bite out of that right away, thinking you make that whole amount over it, right? Now, if I don't work overtime, if I'm not doing thousands and thousands of hours a year, if I'm only doing a few hundred hours of overtime a year, and at the end of the year, I tend to get a big return back because the government has taken it out as if I made that huge amount of money all the time, when in reality, I don't. So if you are going to do the withholding piece of it, there's definitely some strategy you should do. You have to really extrapolate how much you're going to have. Maybe talk to your CPA or your accountant about exactly what you should do with your withholdings, depending on if you're married or if you have kids and things like that. And then really try to map it out so that you're getting at least a small amount back, or try to break even. If you owe a ton or you're getting a significant amount back, that's usually not ideal, right? If we get a significant amount back, that feels great to get this big chunk of $10,000 or something like that. But all you really did was basically gave the government a tax-free loan for the entire year. And then they were able to have your money, and then now you got your 10 grand back at the end of the year, right? So, depending on your situation, your personal stuff, what you like, if you like having that big check come at the end of the year, great. If you do it that way, I would encourage you to take that amount of money and use it to pay off your mortgage, or, throw it at some sort of savings that you're going to be using to, or investments or something like that, if you're going to be using a huge chunk of money for that. But I definitely wouldn't wait on that to be able to pay off your bills at the end of the year, right? So, just a little summary on that piece of it. All right, guys, thanks for joining me today on Finance for Firefighters. I appreciate your time. Same as always, if you have any comments, leave them below. Give me a thumbs up if you like it. I'll see you guys on the next one.